Fear of missing out. The psychology behind market bubbles. 1637, in the Netherlands, a single tulip could cost more than an entire house. People traded their savings, their property, and even borrowed money just to own a flower bulb. It sounds absurd today, but at the time, it felt logical, even inevitable. The value kept rising, and everyone believed the price would keep going higher. Centuries later, in 1999, investors rushed to pour billions into dot-com startups, many of which had no profits, no real business model, and sometimes not even a product. And not long ago, in our own digital age, Bitcoin soared to nearly $70,000 before collapsing dramatically. Different times, different assets, different technologies. But behind all of them lies the same force: human psychology. Why do intelligent people, seasoned professionals, and careful investors keep falling for bubbles? Why do the brightest minds, from professors to executives, repeatedly find themselves swept away in the same cycle of euphoria and despair? The truth is that the markets are not simply numbers, charts, or algorithms. The markets are mirrors of human behavior, and at the center of this repeating story is a powerful force called FOMO, the fear of missing out. Let's make this personal. Imagine Mark, a successful executive. He is cautious, analytical, and respected in his field. He reads financial reports, he avoids unnecessary risks, and he believes in making rational decisions. But when the cryptomania began dominating the news, something started to shift inside him. At work, his colleagues bragged about doubling their money in just weeks. On social media, strangers posted screenshots of massive profits, luxurious cars, and promises of early retirement. The thought of being left behind started to weigh on him. Every day the whisper grew louder. What if this is your chance? What if everyone gets rich except you? And so, one day, Mark opened his laptop, logged into a trading app, and clicked buy. With that single action, he stepped into a psychological drama as old as financial history itself. At first, Mark felt brilliant. The price of his investment went up, and his confidence soared. He imagined what life could look like if this continued: early retirement, freedom, maybe even a fortune beyond his expectations. Each small rise in price created a rush of dopamine in his brain, confirming that he had made the right decision. But then, as it always does, the tide turned. The bubble burst. Within weeks, half of his portfolio vanished. The excitement was replaced with regret, fear, and sleepless nights. What happened to Mark was not bad luck. It was not a random twist of fate. It was the predictable outcome of psychology. And Mark was not alone. Millions of people before him have lived the same story in different times with different assets, but always with the same result. To understand why, we need to dive into the science of decision-making. Psychology has a name for this: FOMO, the fear of missing out. Neuroeconomics, a field that studies how the brain makes financial choices, has revealed something fascinating. When we see others making money, our brain's reward center lights up and releases dopamine, a chemical that motivates us to act. But dopamine does not measure the quality of a decision. It does not predict success. It predicts desire. It urges us to imitate the behavior we see being rewarded, even if we know, deep down, that the risk is enormous. In moments of market frenzy, our rational brain, the prefrontal cortex, often loses the battle to our emotional brain, particularly the amygdala, which reacts to fear, exclusion, and the threat of missing out. This is why investors chase bubbles despite all logic, and why the crowd is so often wrong. The legendary psychologist Daniel Kahneman described this in his prospect theory. Humans feel the pain of loss twice as strongly as the joy of gain. But there is another side to this equation. When we see others gaining, the fear of not being part of that reward can feel unbearable. This herd mentality is deeply wired into us because for most of human history, survival depended on belonging to the group. To be left behind was to risk death. Today, that instinct no longer protects us. In fact, it sabotages us in financial markets. The result is predictable. We rush in too late, we panic too early, and we lose what we worked so hard to build. History is full of examples. In the 1600s, tulip mania saw prices soar 20 times higher than the average salary of the time, only to collapse in weeks. In the 1700s, the South Sea bubble lured even members of the British royal family into ruin. In the 1920s, the roaring stock market seemed unstoppable until 1929, when it triggered the Great Depression. In the 1990s, dot-com stocks promised to reshape the future, but most ended in bankruptcy. In 2008, the housing bubble nearly destroyed the global financial system. And in the 2020s, cryptocurrency and NFTs rose and fell at lightning speed, creating billionaires and bankruptcies in equal measure. Different centuries, different technologies, different headlines, but every single one of these bubbles followed. The same pattern: euphoria, mass participation, panic, collapse. What changes is the asset. What does not change is human nature. But something has made modern bubbles even more dangerous. Social media has turned FOMO into a global amplifier. In the past, you compared yourself to your neighbors or your colleagues. Now, you compare yourself to millions of people online. Every headline screams urgency. Every influencer flaunts their gains. Every push notification on your phone is designed to create a sense of urgency and scarcity. Platforms like Twitter, TikTok, and Reddit magnify emotions at lightning speed, spreading fear and greed across the globe in seconds. Studies show that people exposed to posts about others making profits are twice as likely to invest impulsively. Trading apps add to the problem by gamifying investing. Bright colors, confetti animations, instant notifications, all designed to make you trade more, just like a casino. The result is that bubbles today grow faster, spread wider, and collapse, harder than ever before. So, what can we learn from Mark's story and from centuries of financial bubbles? The best investors are not the ones who avoid risk altogether. They are the ones who understand it. They resist the pressure of the crowd. They focus on fundamentals, not hype. Escaping the trap of FOMO is not about predicting the market perfectly. It is about knowing yourself. It means setting rules before you invest, so that you are not making decisions in the heat of the moment. It means diversifying, instead of putting all your money into the latest trend. It means defining your goals and time horizons clearly, so that short-term noise does not derail your long-term strategy. And above all, it means having the discipline and courage to sit still when the crowd is rushing blindly into danger. Some of the greatest investors in history, like Warren Buffett and Howard Marks, have spoken about this truth for decades. Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." But following that advice is far harder than it sounds, because it means resisting the most powerful force of all, human emotion. Mark eventually learned this lesson. He began to study not just markets, but also his own mind. He realized that mastering psychology was just as important as mastering financial analysis. And over time, he became a stronger, more disciplined investor, not because he avoided mistakes, but because he understood them. Every bubble in history has one thing in common: the human mind. If you can master your psychology, you will not only survive the next bubble, you may even profit from it. Because the markets are not just about numbers or news headlines. They are reflections of fear, greed, desire, and hope. To master the market, you must first master yourself. Master your mind. Master your wealth. This is the psychology of wealth. Subscribe and join us in decoding the hidden forces that drive your financial decisions. The next bubble is already forming. The question is, Will you follow the crowd into it, or will you be ready when it bursts?
Remember, every market bubble is born from the same source: the human mind, tulips, dot-coms, crypto, different assets, but the same psychology. If you master your mind, you master your wealth. This is the psychology of wealth. Subscribe and join us as we decode the hidden forces that shape your financial destiny. The next bubble is already forming. The only question is, will you fall for it or will you rise above it?